Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the basics and the difference between a long condor and an iron condor. So I get a lot of questions, and it's very confusing, to a lot of different people starting to learn how to trade options that sound so similar. So what is the difference between a long condor and an iron condor? So let's take a look. So here's the big difference. A long condor is the combination of two vertical spreads. So what it's doing, it's combining a debit spread with a credit spread. So that's the big difference. A long condor, so you could be long a call debit spread, and then against that, short call credit spread. So a long call condor would be long a call debit spread, short a bear call credit spread. A long put condor is you're long a put debit spread, so that's a directional trade to the downside, and then long a bull put credit spread. So that's the big difference here is the vertical spread difference. You've got a debit spread with a credit spread, and the iron condor is two credit spreads together. So let's take a look at that. So the names get you confusing, the long iron condor, but it's a credit spread. So both sides are credit spreads. So this is a combination of a bull put credit spread, combining that with a bear call credit spread. All right, so that's the key difference. So the big difference also is your profit potential. The maximum profit if you do an iron condor credit spread is the credit you receive. And the other big difference is that you're going to have what we call a negative risk ratio. So whenever you do an out of the money credit spread, so in this situation you're doing out of the money bull put credit spread and an out of the money bear call credit spread, that leaves you, your risk is going to be greater than your potential profit, which is the total credit received. So let's look at the profile. So I'll show you an example here in a minute, but they both, the option profile looks very similar, right? So this is a long condor. So basically, if you look at this, think of this as a call debit spread. So where my pointer is, you'd be long a call here, short a call there. So there's your call debit spread. So you've got a really good profit potential on a call debit spread. And then the other part of the condor is then you sell a credit spread against it. So there, in this situation, you're short a call and long a call down here. So kind of similar to a butterfly, but you're spreading out your zone. So anything in between here is big profit, and you're going to always have a positive risk ratio. So you're going to be risking less than your potential profit. Now the iron condor looks the same from the profile, but it's a totally different animal because here it's two credit spreads. So where my pointer is, you'd be selling a call right there and then buying a call here. So bear call credit spread, and then selling a put and buying a put below it to protect. So a bull put credit spread there. And your maximum profit is your two credits that you receive, and your loss is the difference on the outside leg, and it's always going to be greater than your potential profit. So let's take a look at an example here on Amazon. So let me step you through this example. So yesterday, the 28th of December, we did a breakout trading. See how Amazon broke out yesterday above this trend line, and we had some other technical things. The moving averages that we look at crossed. We also had positive momentum cycle 1 and 2. So potential for a nice burst and push to the upside. So with this trade setup, we did a long call condor to give us a little bit of a hedge against this big spike up to reduce the cost of the trade and also to give us positive data. Now, when we did this trade, I had a lot of questions. Well, what's the difference between a long condor and doing an iron condor? Okay, so here's the deal. Let me show you the difference. So based on this breakout here yesterday, what we did was we went long Amazon by buying, if you look here, this is a condor, bought the 8 January, that's next week's expiration, bought the 3,300 call, sold against it the 3,310. So that's a call debit spread. So long a call here, short the call there, so call debit spread. Now that potential profit there is the maximum difference. It's a $10 wide spread less your cost of 320. So this could make, close to over $700 on that. I'll show you the debit spread side. So here's the combination. The long call debit spread, so the 3,300, 3,310, that was at $450 per spread. Now, the total risk is debit paid. If it closes at expiration next week over the 3,310, this makes $550. That would be 122% return. Now, the other part of the trade is a bear call credit spread. Here's the credit spread selling at 3470, 3480, way out of the money, and receiving $130 credit there. So that would be about a 15% return. You put the two together, now you've got the condor, and if it trades and closes between the short strikes, this trade makes $680 on your risk of 320. So that's a 212% return. Now this trade today went out with a profit of 67. It was up $67. So today going out, it was up 21%. So that's the thing I like about it, and it's got positive data, $10 a day. So here's the difference though on the iron condor. So the iron condor looks similar if you just look at the profile, but you can see it's selling a bear call credit spread, the 34 34.70 short right here, and then long the 34.80 as your protection $10 wide, and then selling the 31.50 put out of the money and buying the 31.40. So the maximum profit is a total of $250. That's your credit received, but if it goes outside your zone here, your potential risk is $750. So you've got a negative risk ratio. You're risking more than you can make. Now today, you can see this went out flat, so it made no money at all. This will not make money until next week. So you've got dead money for a whole week. So that's the difference. And my preference tends to be usually on a long trade is to do a long condor. So you can do this for a put movement down or using calls for movement up. So if you'd like to learn more about these types of option strategies and how to use them for hedging and all kinds of different variations, make sure to check us out at powercycletrading.com. Good luck trading and have a happy new year.